Hi and welcome to Stephan Livera podcast, a show about Bitcoin. Today for episode 325, PlanB rejoins me on the show. Now, for those of you who don't know, PlanB is a pseudonymous quant who is famous for various models, mostly the S2F modeling approach. And so we're talking about whether the S2F model is actually still on track or whether it is not on track, because there's been some discussion about it recently, and the publicized target was this idea that if Bitcoin does not hit 100k by the end of 2021, the model would be invalidated. Now, PlanB and I get into that, as well as spelling out the differences in the different models that he talks about and uses, the failure conditions for the model, and we also talk about his floor model and also his thoughts on the Supercycle. Now, this show is brought to you by Swan Bitcoin, swan.com, the easy way to accumulate Bitcoin while also learning about Bitcoin with various free resources like Inventing Bitcoin, 21 Lessons, and Why Bitcoin. So with Swan, you can start off with a lump sum purchase and then set up your Bitcoin savings plan. And so with your Bitcoin savings plan, that's an automated purchase that pulls the fiat from your bank account, purchases Bitcoin, and then you can auto withdraw that to your cold storage also. Now, if you're a high net worth individual or a company looking to stack, or perhaps you're interested in purchasing inside your IRA, Swan Private can help you here. So swanprivate.com, you get a dedicated Bitcoin expert available for calls to walk you through setup and purchase and various other aspects of Bitcoin. So go to swan.com to sign up. Do you need fiat stablecoin liquidity, or are you looking to earn some interest on your stablecoins? Lend at Hodl Hodl is a peer-to-peer Bitcoin-backed lending platform where you can do just this. You can lend or borrow stablecoins globally and anonymously using Bitcoin as collateral. So for those of you who want to avoid a capital gains event, this might be useful for you. If you need that fiat stablecoins and you still want to retain exposure to your Bitcoin, this is one way to do this. And so when you are doing it this way, you are still controlling 1 out of 3 keys and controlling collateral in escrow through that deal. Now, stablecoin holders can earn interest. You can set the terms and the APR for your deals. So if you're interested, go over to lend.hodlhodl.com. That's lend.hodlhodl.com. Bitcoin mining has become very popular this year, and for those of you who are not sure how to get started, compassmining.io are the place to go. With Compass, you can purchase an ASIC machine, have that shipped to a hosting facility that has been vetted by the team, and you then select a mining pool, you pay the hosting fees, and you are now receiving sats. And this can be done without KYC also, so that's also a benefit for those of you interested in non-KYC stacking. If you're interested to have that machine shipped to your home, that's also possible if you're in the US with Compass at Home. And they've also got a range of mining guides and material that you can get on their website. So go and get started. It's compassmining.io. And now on to the show with PlanB. PlanB, welcome back to the show. So PlanB, lots of things have happened since we last spoke, and I thought it was time to get an update and hear from you how things are going. I know there's been a lot of confusion around the different models that's going on, and people are having this whole conversation about whether everything's on track or whether it's dead, it's over, or is it maybe it's not on track anymore. Maybe you want to just clarify for people, maybe for the newer listeners, what's the difference between the different models that you've put out?
Yes, so the first model I published is the stock-to-flow model, and I guess that's where people know me from. That's PlanB is stock-to-flow, etc. So people are mentioning the stock to flow and are connecting everything I say to stock to flow. But in fact, I use 3 kinds of models. And stock to flow, and the stock to flow cross asset model that came later. Those are what I call fundamental models. They try to on a fundamental level, not on a price level or based on something else, but based on some fundamental thing, scarcity in this case, say something about the value of Bitcoin. So stock to flow is the center, the core of all my modeling. That's true, but there are other models, and for example, the well-known technical analysis models. which are price driven. They're based on the Bitcoin price only, maybe some volume data, but I don't use that. So for example, an RSI, a relative strength index, would be a technical indicator, or a moving average. So the 200-week moving average is something that I use a lot and tweet a lot about. And my favorite technical analysis thing is my floor model that got a lot of attention lately as well, because it nailed three of the last months to the dot. But it's a bit in trouble right now. We'll probably talk about that later. But that's a floor model, and the third kind of models that I use is on-chain models, and that's something very specific for Bitcoin, because Bitcoin has the blockchain and all the transactions are in there, so everybody can analyze all the transactions that and all the blocks that come in every 10 minutes and see if it's big transactions or small transactions, old wallets selling, new wallets selling, and those kind of patterns are very, very interesting. It takes a big computer, it takes a lot of data analysis skills to do it, but it's very exciting. And I must say, I spent most of my time, maybe 80% of my time, in that on-chain data analysis area. So yeah, I'm an investor. I like models. I use all those three kinds of models. So a fundamental model, stock to flow, for example, the technical models and on-chain models. And and I think that's where a bit of the confusion comes from sometimes. But yeah, that's how it is.
I see, yeah. And so I think for people who get confused, they think everything is just stock to flow, where maybe that's not true, right? So because you've got the different kinds of models, and I guess in terms of what is public or out there, it's probably fair to say you've put the most out there about stock to flow modeling, because that's probably what you're known for. That's your claim to fame, so to speak. Yeah. And your floor model obviously has been recently very popular amongst people out there. But I think the on-chain stuff, that's maybe a little bit more of a private thing you're doing, even though arguably, as you just mentioned, that's 80% of your time.
Yeah, that's right. Those are proprietary. The things you find in the on-chain stuff are so amazing and so useful for investing and trading that I'm constantly in a dilemma. Should I put it all out there like I did with the stock to flow, or should I first use it and see if it's working and maybe deploy it in the market instead of publish it? So yeah, I'd like to publish later on some more about the on-chain stuff, but for now it's pretty proprietary indeed.
Yeah, and in many cases it's like if these things were to be published out there, well then maybe everyone would use it and price it in at that point. And so I guess and obviously we've all had that conversation about pricing in has been a big one in years gone by, maybe not as much nowadays. Also, I wanted to touch on one of your comments before we get into kind of, are we on track, off track? You mentioned this idea that price discovery on the open market and that it reminds you of a prisoner's dilemma. What were you getting at with that comment?
Yeah. Well, it was the thought that, in the prisoner's dilemma, the prisoners cannot talk to each other, and then they have to make a decision. If they both say the same thing, they go out free, both. But if they say the different things, they'll sit in jail. And but you don't know what the other is going to say, so you're sort of forced to say to not trust the other. And if they would both win and go out free. And that's the same in the markets. If the sellers would be able to communicate to each other and decide not to sell not to sell at all, or if they must sell for a much higher price, then the price would instantly go higher. So the fact that the very act of selling is influencing the price, and the fact that you're punching in a low number because if you punch in a too high a number, then the trade won't go through, and you won't sell it. So you punch in a low number. But if you would communicate with all the other sellers, like okay, right now we're not selling below 100K, for example, then the price would instantly go to that 100K. But of course, sellers cannot communicate with each other, so they're sort of caught into the going rate and not going too far from the current sell price. But yeah, the fact that you can influence it, that you the theoretical situation that if every seller would decide I will not sell below 100K, then the price would be 100K instantly.
Yeah,
I always like that thought.
Yeah, of course. And I guess at the end of the day, that is a theoretical, obviously, because there'll be some people out there because, some emergency has happened, they have to sell some, etc. But as an idea, yeah. And I mean, arguably, that could apply on the upside and on the downside. And also, I wonder the extent to which the existence of modeling out there that people are trying to, it's like a self-fulfilling prophecy that people think, oh, okay, 100K, well, that's quote unquote fair value, or that they're thinking of it in that way. Do you believe that any of your modeling is influencing the behavior of market participants out there?
Nah, not really. By now I'm a pretty large account, but not large enough to move markets. In fact, I think I had more impact on the markets when markets were a bit smaller, like 2 years ago or something. But no, I think it's much more fundamental than just an opinion or a model that someone that the market follows. I think there is greed and fear in people. That's just human behavior, and that will always be there. So it's very interesting to see that people like to buy Bitcoin when Bitcoin is going up, although prices are, of course, a lot higher than when Bitcoin went down. But when Bitcoin goes down, nobody wants to buy Bitcoin. So yeah, there's always greed and fear, and you can model that, right? You can model that, and also there is momentum in the markets. That's one of the basic thing in all markets, also equity markets, bond markets, etc. That once a trend starts, there is momentum in that it goes on, and that could be because there's a large buyer in the market that cannot buy the exposure they want in 1 day or 1 week, so they need multiple weeks or months to build the exposure, and once that gets going, then it will continue. And so the momentum is a very real thing in markets, which of course all the technical analysis is based, or a lot of technical analysis is based on. And then the really fundamental things for stocks, modeling the cash flows, the dividend flows is a very real thing. For derivatives markets, for example, options, which is basically a volatility market, modeling volatility is very real and very fundamental. It doesn't change.
Yeah, and I think the momentum is a really strong point, and I think I've mentioned this before. I'm sure many others have, that humans are naturally momentum chasing. So we see the thing going up and we all run in. Everyone's running in to buy it, and then we see it going down, and then we're overly bearish. And so I think that is probably the most. I think that might just be one of the best arguments against the supercycle, as it were, happening this time. But I'm curious. I'm sure listeners are curious to get your thoughts. I think you are also not anti, but as in you think it's not the likely scenario. Do you want to explain, I guess, how are you thinking about this idea of the supercycle, this idea that it's not going to be like a big drawdown, or that, the idea of 4-year cycles might be gone? How do you think about that idea?
Yeah, I think you're very right that the greed and fear is something that maybe is the best argument against the supercycle, because that will not go away. And indeed, I think we will not have a supercycle this halving cycle. So next year or until 2024 before next halving, because of greed and fear, because there will be FOMO. Once we hit the 100,000, maybe we will go down a little bit, but once we really have crossed that 100,000 line, then I think the FOMO will set in, and people will just buy Bitcoin, and Bitcoin will go up to unimaginable levels. But then some people will start to sell. They're sitting on a huge profit, and they want to see some of it in dollars, or they get scared, or something happens that scares the whole lot, and then we go south again, and then that will feed on each other, on itself, the fear, and we'll have momentum to the downside, going to the next bottom. I think that's something in markets that is so fundamental that will not go away. That having said, most people that are proponents of the supercycle are technical people or have some experience in investing in tech companies like Google and Amazon. And what we've seen in those prices is that there is a lot of volatility in the beginning after the IPO, because there's a lot of uncertainty about company succeeding and adoption for the product kicking in. But once the adoption kicks in, it goes up in an almost straight line with some volatility, but not the volatility you see after the IPO. So I think a lot of tech investors have that mental picture, and they think Bitcoin will do the same thing. I don't think that is true, because I don't think Bitcoin is a company like Google and Amazon. I think the volatility in Bitcoin, which has been very high and still is very high. If you look at option prices, the implied volatility is around 100%, so between 90 and 100%, which is huge. That's you can't see that in any other market. So a lot of risk / volatility in Bitcoin market, and that is also, of course, where the return is coming from. You cannot have a high return without the volatility. So I think it's something. So volatility is something that is not found in any other markets anymore in the same way it used to be. So, for example, equity markets seem to be going up without any volatility, which is also logical because of all the money printing. Same for real estate prices, up. But the volatility has to go somewhere. The risk has to go somewhere, and central banks cannot print the risk away. So we're seeing the risk sort of coming back in a concentrated way in Bitcoin. That's how I see it, and that's why we have this extremely high returns as well. If you can stomach this volatility, you can reap the profits of the to 100% returns almost on average for Bitcoin annually. So I think the super cycle is a very interesting concept, but it's the greed and fear stands in between. And what I do see, by the way, is that once Bitcoin hits the stock to flow, a scarcity level of higher than anything else on the planet, higher than real estate, with a stock to flow ratio of 100. Once we hit that, and Bitcoin becomes the most scarce asset on the planet, I think that could be the moment when hyper Bitcoinization or the super cycle will kick in a way that it's so much better than real estate and gold and all the other assets that everybody will buy it, and it will probably be the de facto money at that time. So we'll probably, if you look at for example, the stock to flow model at the moment, it uses Bitcoin prices expressed in dollars, because dollar is the world reserve currency, and everything is expressed in dollars. But once Bitcoin hits that 100 stock to flow ratio of 100, and becomes the best money, in fact, in the world, I guess it's time to price everything Bitcoin, and the role of the dollar will be less at that time. But that's after the next halving, and probably not before 2025, 26 or something. But I could see a hyper-Bitcoinization in that sense, a super cycle in that sense, that Bitcoin becomes the de facto money and the denominator of all things valuable. I could see that, but later on.
Yeah, I see. So you see it more like not this cycle, but potentially next. But then what about this idea that maybe 4-year cycles are gone, and actually we might still have cycles up and down, but just not 4-year ones? That, I guess, now to spell out or flesh out that argument, it might be that, okay, the number of new coins coming in now is not that big of a deal, and it's actually more about what the OG or older hodlers or longer time hodlers are doing with their stack than it is about the incoming new coins that are coming in as part of the block subsidy every 10 minutes. What's your view on that?
Yeah, I don't agree with that view. I think that's I understand the view, as in, and most technical people are having that view, and indeed the amount of new bitcoins, or the percentage of new bitcoins, is getting less and less of a factor in the market. But I don't think that is you have to look at it from the other way, and that's also in line with stock to flow view of things, that you have to view it like an investor. An investor has alternative investments, gold, real estate, equities, etc., and Bitcoin. And the fact that when Bitcoin halves, it's the stock to flow ratio will double, and it will put Bitcoin next to real estate by then, and next to gold by now. So people are really comparing it to gold right now because it's as scarce and as gold. That's how I view it. So the fact that it's only very little new Bitcoins coming in the market, and less, by the way, every halving, and that the impact, for example, of exchanges selling their fees is bigger than that, or miners not even selling, but being fully funded through their shareholders, and not having to sell their coins for electricity costs. Those are all maybe bigger factors in the market, but I look at it from the other way, so from the investor way. They're just scouting for scarce assets. And right now, Bitcoin is comparable to gold, and it will be comparable to real estate, and that will be a big change in the eye of the investor.
Back to the show in a moment. Now, if you're looking to start self-custodying your Bitcoin, or you want to upgrade your Bitcoin hardware, look at the Cold Card by CoinKite.com. CoinKite are a long-standing player in the Bitcoin industry, and in recent years they've been focusing on hardware. So the Cold Card is like a little calculator-sized device. You can use it to generate private keys, store private keys, use it essentially to hold your Bitcoin or to send Bitcoin. Now, you can use it easily by directly plugging it into your computer if you're a beginner, or if you're intermediate or advanced, you can use the micro SD card option and learn how to do it in an air-gapped way with a PSBT, partially signed Bitcoin transaction. The Cold Card offers all sorts of features. You can use it single signature or as part of a multi-signature easily with wallets like Spectre, Sparrow, or Electrum. So go to coinkite.com, use the code Livera to order yours with a discount. Brains are a Bitcoin mining company through and through, and they are working on various projects that support Bitcoin mining. That includes Brains OS Plus, which is firmware that can be installed on ASICs. They run Slushpool, which is the first Bitcoin mining pool, and they're pushing forward adoption on Stratum v2, which is a next generation pooled mining protocol. So with Brains OS Plus, this is aftermarket custom firmware. You can install this on your ASIC and use the main feature, which is auto tuning, optimizing your performance to get you more hash rate for your electricity bill. So if you want more sats for your buck, make sure you check out Brains OS Plus. And don't forget that they also run Slushpool, the oldest Bitcoin mining pool, which recently celebrated its 11th birthday. Now, they've got all sorts of features on this side as well. They've got ultra-flexible payouts that can be either time-based or threshold-based. You can also use the feature of paying 0% pool fees by running Brains OS Plus and pointing your hash rate to Slushpool. So if you're interested to find out more, go to brains.com. That's brains with 2 I's. As the price of Bitcoin goes up, it's time to think about security. And with Unchained Capital, you can create a multi-signature vault. So with Bitcoin security, we want to remove single points of failure. And this can be an exchange. It could be a single hardware wallet that you haven't backed up. There's all sorts of ways that we could fail in our security. And with Unchained Capital, you can create a vault, a 2 of 3 vault, where you hold 2 keys separately and put them in different locations, and Unchained holds the 3rd key. And they can countersign for you if you need that. Now, you can actually set this up and create the vault for free. There will be a fee if Unchained have to countersign for you. Now, if you need assistance, there's a concierge onboarding program where they will ship you hardware wallets and teach you how to do this, even if you've never held your keys before. So if that's appealing to you, go to unchained.com, select the concierge onboarding program, use the code Livera for a discount there. Now back to the show with Plan B. So I guess historically, if we were to look at it, there were times where there was essentially a multi-year bear cycle. So 2014 and 15 and part of 2016, and then obviously 2017 was a big run-up, and then you could arguably say 2018 and maybe 2019 and 2020 was sort of like bear-ish years, and then obviously this year, 2021, has been a huge big bull run, and I guess the end of 2020 was a big bull run as well. So if we were to see, like, are you essentially arguing then that we could see a similar thing happen, that we may see a huge momentum come in, and then again, the cycle turns at some point and we have potentially a multi-year bear again before the next bull run?
Yes, and I don't know if it's multiple year. All the bulls and bear markets are different always. They're never exactly the same. But yeah, I think we go up. The bull run isn't finished yet, and it will go beyond the 100k level towards 200, 300. You know, in last bull markets, the Bitcoin price went up 2x or 3x or sometimes even more above the stock to flow levels. So yeah, we could see 300k Bitcoin. That would not surprise me. But after the next all-time high, we will fear will kick in and we will see lower Bitcoin price. And I guess that will lead to there will be a trigger that triggers that fear and that downward movement. And that could be a government thing. It's mostly a government thing. That could be it could be anything, but yeah, I wouldn't be surprised. But it could also be just a very short bear market this time, only half a year or 1 year. It doesn't have to be multiple year, but yeah, it could be. It could be that 2022 is a bull year. 2022 is a bull year. So next year, another bull run. 2023 is a bear market. 2024 we'll stay in the bear market, and 2025 will go up again. I wouldn't be surprised to see that happening like that.
I see, yeah. And so the way I'm seeing it or thinking about it is that, so as we were saying, this whole momentum chasing idea, that on the way up, there's all these people who are chasing they're seeing the number go up and they haven't really studied this thing. And then eventually, as it turns, we fall to the level of the quote-unquote DCA army or the Bitcoin savings plan. That sort of is the level who are holding the support. So I guess maybe that's where the Supercycle people are saying essentially that there's going to be such a phase shift or such a step change in the way people think about Bitcoin that there will just be all these new people who are accumulating Bitcoin, and therefore that's why this kind of idea that the Supercycle is going to happen, and therefore it won't be a huge drawdowns coming, because it'll just be steady continual adoption. So I'm wondering your reaction on that.
Yeah, I hope that were true, but that's how it felt last two bull markets as well. Like, this time it's different, and we won't go down anymore, and that's why you have to protect. I think you have to protect yourself against that feeling, because I know how that feels. You think it will go to 1 million straight up, but. Yeah, but I like your argument. It's the DCA army, or the hodlers, the army of hodlers that's constantly adding and not selling. You could, for example, see the 200-week moving average. That's a 4-year moving average. that's an indicator, technical indicator that sort of measures the average price of the last 4 years, and that measure goes up. Always goes up. It never goes down, and Bitcoin monthly closes never fall below that 200-week moving average line. So it's a very interesting indicator, and I guess that's indeed that's how I long term would see Bitcoin. It always goes up, and there's a lot of volatility above that 200-week moving average, which you should ignore, and it goes up. In the long term, it all goes up. But it already did that, right? Last 10 years, and I think next 10 years, could be like that. Not necessarily an acceleration of that 200-week moving average. So which would be the case if there were a super cycle.
Yeah. So I wanted to turn now to the question of evaluation of these models, because I think there's a lot of back and forth. People are saying, there's some people out there who are saying, no, it's S2F modeling is dead. And there are others who say, no, it's still on track. How do you think about that? How do you think the model should be assessed? And I remember one of our earlier conversations, you were saying, put in short terms, in simple terms, if Bitcoin is not over 100K by the end of this year, 2021, that you would then say, okay, that model is probably failed. Do you still hold that view, or has your view shifted here?
Yeah, and that's a bit of a short measure, or a bit of a simple measure. But yeah, I still hold that view. I think stock to flow is tracking very well since it was published in March 2019, when Bitcoin was below 4,000. So it tracked really well. It mainly predicted that the halving would trigger another, was not priced in and would trigger another bull run, which we saw. We're now sitting at a bit below 60. What is it, 57 or something thousand? So if you look at the charts, for example, this bot of Bitstein, which can be found on Twitter, it's the stock to flow multiple called S2F multiple, and it tracks the performance of the model on a daily basis. And you can see that it tracks very well, within most of the time within a 1 standard deviation band, and it went a little below the 1 standard deviation band into the 2 standard deviations band lately, but came back up from there, and we're now smack back in the 1 standard deviation band. So and going towards 100K. So yeah, I think it tracked well as advertised, and I'm very even I am a bit amazed by that, because the model should not work at all. In fact, right, the efficient market hypothesis, you cannot model the market. But I think the proof of the pudding, the real victory lap, or how do you call that, is when we cross that 100K barrier. I guess that's the thing, and I guess it's good to explain that when you read the article, when you see how the model is made, it's just a normal regression analysis. It's nothing spectacular, nothing exotic. It's very, very simple, one input variable. But what it basically says, it's after the 2020 halving, the price level should be on average for that halving period. So until 2024 should on average be $100,000. So that is the real proof or validation, if you will. If we track, if the data still fits that very simple linear regression, then it's all okay. But since technical analysis people somehow don't really understand the average linear regression thing, and are really used to think in levels and price targets, I shouldn't say dump that down, but I simplified that into if it should be 100K on average, then 1.5 year into the halving cycle, so 1.5 year after the last halving, it should at least cross that average of 100k, because otherwise it will be very difficult to be 100k on average. We should spend a lot of time above 100k to even make that average. So yeah, at some point we should cross that line. And I guess historically looking to last two bull runs, 2017 and 2013, that point is, about 1.5 years after the halving. So that's how I came up with end of 2021, it should be above 100k, which is very short and snappy, and technical analysis people understand it. So it's not so it's really the average that we should be looking at, but the 100k is short and simple.
I see. So just to summarize then, the idea is, let's say we're looking at the stock to flow model. The idea then is that the price of Bitcoin should be, we can sort of say, oscillating around 100k, just as an example. And so the simplified version that you gave was that the price should at least cross 100k by the end of this year. And you said that, I think, last year. And so you're also thinking of that as like a average over the cycle. So another, I guess, important thing to note is that Bitcoin can really move a lot in a short period of time. So it could very well spend most of the year well under 100k, and then just at the end run really high. Or I guess the other aspect would be if the model, or let's say if the price of Bitcoin goes, well over 100k next year, then it can spend also a lot of the time above 100k. So I'm curious then, is that how you're seeing it? Are you just essentially seeing it like there could just be really big price moves towards the end of this year or start of next year?
Yeah. Well, if you go for the Supercycle, it could be like that, right? We could be below 100k, and then maybe a half next year go to a million and spend and beyond, and then still hit that 100k average. But I don't. If theoretically that could be, but that's not what I expect. But yeah, so basically you can only say until next halving, really. But if the model is if the 100k average is reached, but yeah, I think I think on average that should be. And there's another argument, by the way, against that. We spent, for example, 3 years below 100k, and the last year far above 100k, maybe at a million or something. And that is the fact that if you look at the stock to flow model, and I find that very important, then the Bitcoin price is above and below the model value each and every year. So it really oscillates, like you call that, around that model line. It really stays close to the model line, and that's a very important thing. And there was a whole co-integration discussion when the model came out in 2019, which is very interesting, and that sort of hit on that fact that the Bitcoin price stays very close to the model, and there were also some sorts of formal tests for that possible co-integration, which in the end we could not apply because stock to flow is not a random variable. But it's a very, very important thing, nevertheless, that in my opinion, that the price of Bitcoin is below and above the model line each and every year last 10 years.
Yeah, right. So in your point of view, that should not be seen as like a coincidental thing or not relevant fact for you in your mind. That's quite an important point. Just yeah, and it means that we should not stay below 100k, for example, next year, and then shoot up to 1 million in 2023, and make that. And still make that average of 100k, because we should go above 100 this year, but at least we must. If we don't go above 100k next year, then for sure the model failed. Yeah.
In my eye.
I see. And so there's been a lot of talk around CAGR, right, compound annual growth rate, and so that 200 number gets thrown around, and as we speak today, as an example. the 10-year version of that number, it's about 170%. Although, of course, I think it's only fair to say that should taper down over time. And it's not fair to say it's going to be 200% every year going forward, because it's just not going to sustain that. I think it's probably more like my friend Haas says, something in that 60 to 70% range is what we might realistically see for the next coming years, and then it will taper down over time, and then eventually the model has to fail, as I think you've mentioned as well. What's your thought on that idea, like this idea that it has to taper down and that eventually the model would have to fail?
Yeah.
What and how would you know?
Well, those are 2 points. So first, indeed, it's the annual rate. If you look at the last 10 years of Bitcoin, is 170% growth or profit, and that is high, of course, and it's a lot higher than you would expect from the, for example, capital asset pricing model. That's a Nobel Prize winning model that, despite all its critics, is still used a lot in the financial markets, where you can look at assets from a risk and return point of view. So given the risk of some asset, the volatility of some asset, there should be a return that sort of makes up for that risk. And the risk of Bitcoin is high, but the return is much higher. And I mentioned the risk, the volatility of Bitcoin is, if you look at option price and implied volatility, it's about 100%, but the return is 170%. So the return is higher than the volatility, and that is very rare to see in the market. So all other assets, bonds, gold, equities, real estate, all other assets have returns that are lower than the volatility and or the drawdown, depending how you measure risk. But and that's a very distinct thing from Bitcoin. Technically it means the Sharpe ratio is higher than 1. So the Sharpe ratio is the return divided by the volatility, the risk. So it's 170 divided by 100 for Bitcoin. And that is very distinct, and I don't know if that will fall, actually. I think the current central bank policies and the weird stuff we're seeing with the money printing and even negative interest rates in the part of the world where I live is putting financial markets upside down and making price discovery almost impossible. And you cannot kill risk. It seems like no company is allowed to go bust. Defaults are not allowed, because the central bank will come in and save the bank or save the airliners or whatever. And the same we're seeing right now with the whole COVID. People are not allowed to die, and we're doing everything to even the most stupid things to prevent it. But the thing I'm getting at is that risk is not going away because the government say it's going away. That risk, especially in financial markets, just goes somewhere else. And I have the feeling that Bitcoin is the new frontier, the last place in the world, if you will, where risk and return can be truly present, and where true price discovery can take place. And that's a very fundamental thing, very, very, new way of looking. But so the whole question then boils down to risk. Is risk going to go away for Bitcoin? Because if that is the case, well, then the returns will come down gradually from 170% to 100 to maybe 60, which would be in line with other assets. But I don't know about that. That's not what I see at the moment. It could also be that the very distinct exponential trends and the non-normal distribution of returns of Bitcoin, very, very much following power law distributions, that characteristic stays for Bitcoin.
I'm also curious to ask around Bitcoin and how it fares during a crash. So as an example, people might say during March 2020, everyone was trying to go to USD cash, right? So that's where basically a lot of things all went down. And obviously Bitcoin at that time, I think it was maybe 9 or 10,000, and it crashed to maybe 3 or 4,000, something roughly like that. And so the argument might be, now again, I'm obviously more orange-pilled and Bitcoin hodling myself, but hypothetically, people might argue, look, people have US dollar denominated debts or obligations. They need to make rent or payroll or various other obligations, and that's in USD. So that's why there's this big sell down. And so I guess that's the question that people might be thinking is, during a big crash, during a big financial crisis, could that also happen to Bitcoin? Or do you actually believe, and maybe that's like the bull argument, that people are eventually going to see more safety in sats than they do in the US dollar? What's your reflection or thought on that?
Yeah, that would be nice. But indeed, March 2020, the COVID crisis, everything went down, right? The bond market, the equity markets, and even Bitcoin went down. So people have to sell everything because they lose their job or their company is in bad shape. They need money, and indeed they need the money in dollars or other fiat, and they need to sell their assets. So I guess, yeah, that sort of stays. On the other hand, like you say, personally, when I sell Bitcoin, then I have this cash on my bank balance sheet, on my bank, and yeah, it feels like more risky than having it in Bitcoin, because yeah, the inflation is eating the purchasing power of my euros away. The banks can block the account, freeze the account, can do everything with the account. It's much better feeling to have it in Bitcoin and going up all the time instead of having it in fiat. So I'm personally selling only what I need for food and stuff, but not more than that. So I could see, but the counter argument, of course, is that if you keep it in Bitcoin, you should be okay and at ease with all the volatility in fiat terms of your stash, right? That's you should be okay to see it half in dollar terms, and like we saw in May and June when the Chinese ban was there. And if that's okay, then because you know that it on average it will jump back again, and on average there will be this 170% growth rate annually, then this is the most perfect investment there is. So yeah, I'm also very hardcore in that. I'm okay with the volatility and keep it in Bitcoin rather than turning it to cash. But in these very distinct crisis situations like March 2020, some people don't have a choice. They have to sell. And of course, leverage is playing a part here as well. So one of the reasons that there was a big sell-off in Bitcoin, a very steep sell-off, by the way, in Bitcoin in March 2020 was because of all the leverage longs that were killed and liquidated. And those people have their stop losses put in, see the price go against them, go down, and they don't want to sell because they hope they know it will go back up again, but the exchange will sell it for them. They will be liquidated by the exchange. And there's so much leverage in Bitcoin, which I think is very stupid for people to do naked longs or shorts without having the underlying.
So I think
that example that makes it worse.
Coming back to what we were saying earlier around momentum and how people are thinking when they're in the euphoria phase of the bull run, that's when a lot of people will leave it up, and so that's typically when you can see these big deleveraging moments where the price comes down a lot. And so at least historically, the way it sort of moves, it's almost like a 2 steps forward, 1 step back dance. And so it kind of comes up a bit and then back, and then comes up again and back. And so, but eventually that dance is over, and it's the end of that kind of overarching cycle. And so at that time, and to use an example of 2017, the 20K was the top, right? But what happened is after that dropped down to say 14K or whatever, people were still wondering, well, hang on, are we going to do another 2 steps up, or is that it for this round? And it took some time for them to know, oh yeah, actually we are done for this time, and we're going to have to wait until the next big overall cycle. But in the minds of people out there, they might still be confused because you're not clear whether that was the top or whether we're still about to go back up again.
Yeah, and it's always interesting to go back in time and look how you felt in March 2020. Were you close to selling, or didn't you feel anything? And
Or were you trying to stack hard?
switch
Yeah.
off the monitor and go sailing or running. Yeah, yeah, and that's by the way why I say when the price goes down, I just switch off the monitors. I do a tweet like I'm sailing or I'm running, because that's really what I'm doing. Then I'm just go I switch off the monitors and go away from the desk and into nature to to not have to look at yeah, because you might be overcome by fear and sell, and and you have to protect yourself against that if you have the confidence and opportunity, of course, to set it out.
And so this whole conversation around macro and Bitcoin and broader conversations around nation states and their adoption of Bitcoin or their response to Bitcoin, I'm curious around your thoughts there. Do you see this like there will be nation state level mining, or do you think it makes more sense for them to simply accumulate without mining and either purchase or even print and purchase? What kind of adoption do you see making sense for nation states?
Yeah, I think they'll have the same decision to make that all of us have made individually earlier on, and that investors have to do, and institutional investors have to do right now. To buy Bitcoin now would mean you're one of the first people or countries to do it, like El Salvador did, and they get all the flack for it and also all the compliments. But from the traditional world and the IMF, for example, they get the flack. So yeah, it's a first mover advantage, but it's also a first mover who gets all the critics. So yeah, you have to have balls. You have to have a small country with a leader that can do such a big change. But I guess it makes a lot of sense, right? It makes a lot of sense because the alternative is to be rescued by the IMF continuously and eternally for smaller companies, but also for the bigger companies. The central banks play such a large role at the moment. They save all the banks in 2008. They saved all the companies after COVID, March 2020. It seems that even the very big countries like US and all the countries in Europe cannot operate without the money printing of the central bank. So yeah, it's either that or hedge a little bit into hard assets like Bitcoin or gold or. Well, I find it very interesting what the Chinese are doing at the moment. So they're buying. They of course have a lot of the U.S. debt, a lot of the U.S. treasuries, and if something were to happen with the U.S. dollar, as in high hyperinflation or a debt rescheduling, then of course the Chinese treasuries would be hit. And what you see is that Chinese are buying a lot of stuff in real stuff, right? Gold mines in Africa, cobalt mines, all the commodity mines in Africa, all the strategic important infrastructure like harbors in the Middle East and Europe, and even in the US. So it's very interesting to see the Chinese government buy real stuff, hard assets, and of course the hardest asset in my view would be Bitcoin. Because it's better than gold, scarcer than gold in a few years, and more portable, more divisible. It's thermodynamically the best thing there is, and some governments will figure that out, like El Salvador, which is of course a small country, but I guess that will see some other countries following that up, and then it becomes easier and easier for other countries to adopt because they're not the first mover anymore. But I'm quite sure some countries are analyzing it now and are making plans to add Bitcoin to the reserves or switch to legal tender, which El Salvador did, which is a very ballsy move. But yeah, I think it brings great wealth to a country, and but it is high risk.
Speaking of El Salvador, so they have made Bitcoin legal tender, and I'm sure you've seen the recent announcement about Bitcoin City and the use of a specially structured bond that will actually be giving out Bitcoin dividend. So I'm curious if you've had a chance to look at that Bitcoin City idea and Bitcoin bonds, and whether you have any reactions to it or any analysis you've looked at.
Yeah, I didn't look at the city bond as much, but I did look at the volcano bond. Maybe that's the same thing, but the mining.
I think they are one and the same.
Okay. So yeah, the mining bonds are very interesting, and it's of course mining is a very profitable thing, and giving notes or bonds on that operation is a very a very logical thing to do with Blockstream, of course, doing that already with the nodes, the Blockstream mining nodes, where you can participate in an otherwise very capital intensive, a very large capital investment. You can now buy small parts of that investment and still earn that quite huge returns. So I think that's a very logical, very nice thing to do, and a method of making it accessible to traditional investors, because bonds and notes they have ISIN numbers. They can be put in the investment administration systems just like a normal bond and or shares. And it's a very, very smart thing to do. I think we'll see a lot more of that.
Yeah. To your point about easy coding and putting into the system, it's crazy how much inertia there is. So I recall at the announcement, President Bukele and Samson Mow of Blockstream were saying the code would be EBB1, right? And that was the El Salvador Bitcoin Bond 1, and I think that'd be the first of a range of these to come. So it might just be that it makes it accessible to people who are otherwise stuck in investing in the more traditional world, and potentially even for the retail investors, there might be a reason for them if they are getting permanent residency in El Salvador with a track to citizenship. But I guess that is the question for some people, because for many people it might just be like, well, I could just be holding Bitcoin. Why do I want to hold this? And so I guess they would have to think about why they would want to do that. And in some cases it might be access. In some cases it might be they want the permanent residency. It might be they want to retain some exposure to Bitcoin as opposed to buying property, or they might want some level of Bitcoin exposure. So I guess those are some ideas that I'm thinking of. Do you have anything to add there, or do you agree, disagree?
Yeah, no, I agree, and of course the bonds and the mining nodes, those have very different risk profiles than Bitcoin. They don't drop 50%. In a week, for example, like Bitcoin. So the return would be a little bit less, but the risk is much less than Bitcoin. And but still, and especially for traditional investors that are a bit scared of the volatility of Bitcoin, which is logical. I mean, 100% volatility is just too much for all banks and insurance companies. But so the risk return profile is different than Bitcoin, so it makes a very nice addition to Bitcoin, the asset.
I see. Yeah. So in my mind, I'm sort of thinking of that tension or the clash, because I'm sure some listeners are like, screw that. Why are you talking about mining Bitcoin mining stocks or Bitcoin mining notes and Bitcoin bonds? Like, just hold Bitcoin. But on the other hand, it's the right tool for the job or for the right person, right? So of course the retail, highly convicted stacker and hodler is thinking, no, I just want to hold sats. I just want to hold Bitcoin. But then maybe some of the institutional investors or other people who are thinking, well, as an example, they might be buying MicroStrategy because they want Bitcoin exposure and it's easy for them. Or they might be buying Grayscale, or they might be doing the GBTC thing, or they might be looking at ways to get exposure by holding the mining stocks or by holding the mining node, or in this case, the Bitcoin bond, because they're not at the level yet of being able to sustain or take that volatility of just simply holding Bitcoin. So I guess that's maybe an exploration for the different kinds of people and the different kinds of reasons that people would buy these different things.
And of course we have fallen in love with Bitcoin, and Bitcoin is so much more than an asset. It's a way of living. It's a culture. It's a revolution and a new geopolitical thing. It's much more than. But an investor, of course, a traditional investor, he's very yeah. A big institutional investor, he doesn't mind what he's investing in. He looks at all the investments at the same through the same scope, and that is risk return. So if it's better in risk return terms, and within his mandate, which Bitcoin is not at the moment, but then it's okay. If it's better, they go there. If it's they'll add it to the portfolio, and but they will never fall in love with Bitcoin like we do.
Yeah, I see. And I guess a similar kind of idea is other vehicles of investing. So there might be other people who are more comfortable with the likes of an ETF. So, of course, while that might not be appropriate for those individuals who want direct exposure, I'm curious your thoughts there. Do the ETFs represent some kind of centralization risk to Bitcoin if, let's say, all the coins end up in the hands of one big ETF custodian? Or are you looking at it maybe another way to look at it is it's just inevitable. It was coming anyway, and so it's time to it will just exist alongside the, let's call it, the more open peer-to-peer Bitcoin world.
Yeah, it's less peer-to-peer, but I don't see the concentration risk as a big problem, or I see it as a big opportunity, a logical thing. A lot of people, especially through pension funds and normal investment schemes, cannot buy Bitcoin because the asset manager cannot hold the Bitcoin. Their systems are not adapted to private keys or don't have links to custodian services. So, but they can of course buy futures and in gold, in everything, and also in Bitcoin. So it's very easy way of acquiring some Bitcoin exposure for traditional investors, and that's no problem at all. Also, not if it's just a future ETF. It just means that there is a counterpart that takes the first 10-20% annually for as a reward for having the spot exposure and going through the trouble of having the keys and the custodian services right. But the traditional investors and the future ETFs are willing to give that 10%, 20% contango premium up and go for the other, 170 minus 10 is 160%, which is still a good deal and fits within their systems and legal framework. So, no, I think it's just a normal, situation, how things should go.
Right, yeah. So, I guess just to summarize some of the other points we were talking about earlier, as we were saying, around the 100K by the end of the year. So essentially with stock to flow model, essentially the simple way was hitting 100K before the end of the year, but the other way could just be sustaining a number well above 100K for, let's say, the next 2 years after the end of this year, something like that. And then in terms of the floor model, I think you got, was it 2 or 3 months in a row, pretty much on the number, but it might be a bit difficult. As we record this, it's the 25th of November, and the price is about 57K. I believe, I can't recall off the top of my head, but I believe your floor model had it something like 98K, meaning we've got about 30K to go in, 7 days or something, 6-7 days?
Yeah. I won't say we're still in play. I guess it's pretty, almost impossible to reach that goal. So I guess that will be a first miss after those 3 hits, which does not impact the stock to flow model, but it is a signal for me that something is going on because this hasn't happened in the last 10 years. The floor model is a technical model, like I said, based on price of the last 10 years. And this is just an extrapolation of that. And the fact that it didn't hit the 98 is, in my view, an outlier, a black swan event. I don't know why, by the way. I have no idea why the price went down last couple of weeks. Could be the Mt. Gox thing. Could be just a technical issue. So a consolidation after a big rise. It could be anything, but I couldn't point exactly what it is. But it my eyes, it's an outlier. So In fact, I keep the 135k prediction that the floor model gave for December. I keep that. I still keep that up, and I expect this as a the hit or the fail. Sorry, of the 98. If if we fail to hit 98 in 5 days, probably will. But I see that as an outlier and probably a V-shaped recovery after that, and then. If that does not happen, so if we also miss the December, then the floor model is out of the window and broken. But a model, I think that's a good point to make. A model is not broken by the first miss. So a model is never 100% right. It can't be, because it would not be a model, a simplification of reality. So there will be misses. This is a miss. It's a big miss. But it should be a one-off. If it keeps missing, if it's not continuing, it's nailing the other month's track record. Sorry, then then it's not okay. But missing 1 month is not a problem for me, at least.
I see. And, it could be that in the next 5 days we see a bit of a run-up, so it's not as much of a miss. Who knows, right? So I guess that's probably a good spot to finish up. Any closing thoughts that you wanted to leave the listeners with, Plan B?
No, well, I have got a lot of new followers lately. It's about 400,000 last month and the month before that. So it's really a large number of new followers. I would urge those followers to read my articles, the original old articles from 2019, 2020, because a lot of the questions that I get are all answered in those papers, and of course there's a lot of interviews that I did going into depth for all the questions that are asked currently, and all the previous podcasts and interviews are on my website, planbtc.com. The articles are there as well. So especially for the new followers, go to that website, planbtc.com, and you'll find and make sure you read the articles and listen to one or two of the latest interviews. That would certainly give a lot of insight.
Fantastic. Well, pleasure chatting with you, and thank you for joining me, Plan B.
Thank you, Stephan.
I hope you enjoyed the show. Make sure you subscribe using your podcatcher application. Search Stephan Livera Podcast, and the show notes are over at stephanlivera.com. Thanks for listening, and I'll see you in the Citadels.